Hi everybody, continuing with our accounting work here. We're starting chapter 6 this week, and this week we're going to do a part of chapter 6, a part of chapter 7, and next week we'll have the midterm exam, and the midterm will be online as an exam in Connect, and I am actually going to do just a depreciation piece in chapter 6. So as you see, it's only through slide 32 of the PowerPoint, and we're going up to page 193 in the book itself. So, and then chapter 7 we'll go over the metrics. It's also just going to be on the first part of the payables as well. So with this chapter, what we're going over is depreciation and basically looking at non-current assets in terms of land, building, equipment, and there could also be intangible assets as well in this group of assets. So what we're going to go over is what happens when you purchase these assets, what happens as you use them, what is depreciation, and basically how to do the accounting for depreciation is the main focus of this specific section. Now, in terms of purchases, when we purchase something, what does it mean to capitalize it? When we mean to capitalize something, it means that we're basically not going to use all of it in the period to come. It's not like buying, for example, gas for a car. You know, we're buying something, a building, equipment, a vehicle, we're going to use it for more than several years. So capitalizing it means that we're going to keep it on the balance sheet as an asset and use it every year to a certain extent. And that's what depreciation means. Now, first of all, when we buy something, what kind of journal entry do we enter, right? When we buy something, we're basically allocate cost to whatever it is that we're buying at the purchase price. So here we're seeing we bought land and building, and we're allocating the purchase price according to a percentage, and we allocate a certain cost. Now, when we buy something, we always allocate the fair value of the cost to the actual asset. And how do we put it on the books? You see on page 187 in the book, we have credit to cash and debit to the appropriate asset, and that's how we put it on the books. Um, and then as we see here, whatever the additional fees are that are here, installation, transportation, purchase, architectural fees, cost of permits, can be added in addition to the actual capitalized amount when we do like a vehicle or purchase a house or build a building. Now, what is exactly depreciation? I'm going to go over in an example problem to also show you what is depreciation. There is a main example that I want to walk you guys through on page 190 of the text, and then we'll go over an example problem here in the PowerPoint. But to walk you through the page 190 in the text, basically what we have going on here, Cruisers Inc. purchased a molding machine at the beginning of 2016 at a cost of $22,000. The machine is estimated to have a useful life to cruisers of 5 years, an estimated salvage value of $2,000, and estimated the machine will produce 200 bolt holes before it wears out. So with straight line, what we're looking at always is the cost less the salvage value divided by the useful life. So if we have in this situation 22,000 cost minus 2,000 salvage value divided by 5. So the annual depreciation is 4,000. So with a straight line, it's usually very basic. Once you figure out the base, you simply divide it by the years, and your annual depreciation is basically how much you use up that asset in that year. Now, with the units of production depreciation, we basically figure out the base and divide it by the number of units we expect to have produced from this machine. So if we have 22,000 minus 2,000, again our base is 20,000, divided by 200 holes, 20,000 divided by 200, we have basically 100 per unit. So every time, say you produce 20 units, you would depreciate that year by 2,000. Also very straightforward. Again, figure out the base, multiply by the units, and that's how you get that number. Declining balance depreciation. This is basically, you see what is the straight line rate. In this case, it's 1 over 5, 20%. So every year we exhaust 20% of the total. And you multiply by 2. So you simply say double declining. It means instead of 20%, it's 40%. So the first year's depreciation is 22,000 times 0.4, and that's equal to 8,800. Then you subtract the 8,800 from the 22,000, you get 13,200. And then next year again, 13,200 times 0.4 is your depreciation. So again, this is on page 190. Just go through this table in detail and it becomes very, very clear of what's going on. And this is basically the concept of what's happening. Just to go over one more time, there's another PowerPoint that I wanted to go through in terms of the example problem for the week, and I'll post this as well. But basically, to show you another example, we have basically a computation of straight line depreciation here, and the annual depreciation expense is the amount to be depreciated by useful life. We have a base here of 1.2 million, salvage value of 180,000, 8-year useful life. So the annual straight line value is 127,500. We can see after 5 years of depreciation that would be 637,500. Using declining balance, what is the depreciation on the third year? So if we're going to use declining balance, we can see if the straight line rate 12.5%, what's the double declining rate? It's just double, it's 25%. So if we apply 25% per year, starting with, and notice you start with the total value, not less salvage value, you can see the annual depreciation here, and every year you subtract what you depreciated. So by the third year, the net book value is 506,250, and that's what you get here, and you look at your accumulated depreciation. These are the two methods that I want you guys to focus on. And for this chapter, this is what we're going to focus on really. It's just the depreciation, and the next video I'm going to go over to chapter 7 and go over on of the first piece as well.